Hello, welcome to this podcast. Today is our market located in Buffalo, Niagara Falls, New York, investment opportunities. My name is Si Wing Yi from the Yi Real Estate Network. And today's live event, I have my special guest, Caleb Kanazi from Buffalo Turnkey. And his company has been helping real estate investors from different part all over the country and overseas, especially across the pond in Canada, very close by Niagara Falls, and also overseas buyers from the Middle East and UK, Australia, wherever. Caleb, I mean, so you guys been doing it for a very, very long time, for 30 years. You guys are family-owned business, and this is your niche. This is your market, Buffalo and Niagara Falls, and you've been helping real estate investors for many, many years. And we've been working, my network has been working with you for several years now, and we have sent a lot of investors to you to buy out-of-state turnkey properties. And I really appreciate you, Caleb Kanazi. You and your team has helped our investors quite well, and we're pretty happy about it. And so it's an opportunity for Caleb to connect to our investors live. Oftentimes we do it not live, through remote communication, by email, by phone. So Caleb, I just want to, what I want you to discuss is to just have a basic high level review. What's the value proposition in your market, Buffalo, Niagara Falls? It's not a mainstream market. It's not a sexy market, if you will. But savvy, smart investors understand, Caleb, that your market, your properties that you represent is an important part of the overall portfolio acquisition for a lot of my investors. As a matter of fact, this is a good hedge, is like an asset allocation, a diversification. So a lot of our investors have purchased high appreciation, low cash flow portfolios in other part of the country, Caleb, like in Texas or Florida, and all that, where the cash flow is very low because of the rising appreciation. So it makes sense for other investors to diversify and buy in your market, because your market is low cost, high cash flow, very good rent to value ratio. And so one more thing I want to say before I'll let you take over, Caleb, is that you guys have a very good system because you've been doing this for so long. You have you just provide a very good product, and people trust you, and you provide the return, the cash on cash return that people need in order to, like I said, in order to diversify their portfolio. So go ahead, Caleb. Tell us about. You guys are, it's a family business, so which is good. You know what you're doing. You buy properties in your local neighborhood. You know what to do, what to look for, and you guys have your rehab team, your contract team, the whole team work in such a coordinated way. So at the end of the day, you sell off-market properties to real estate investors like us. So without further ado, everyone, Caleb Kanazi from Buffalo Turnkey. Take it away, Caleb.
Yeah, so basically, what we do is we buy properties at a lower value, and we have the ability to fix them up. Not every property we buy is going to be fully rehabbed. A lot of properties we're buying with tenants already in them. So for those properties, we might not just kick out the tenant just to do work, but basically any property that we sell, we're willing to do work on the property as well. And we do a lot of work, just basically anything that needs, but not everything is just always going to be updated. The rehab is kind of just going to depend on what the house needs, more or less. And then another thing you were just saying a little bit ago was about the cash flow. Yes, there is good cash flow here, and if you kind of sell the sheets from years prior, we used to have a lot more inventory, and also you would see a lot higher return on investments too. So we have seen It's not just other markets that have seen appreciation. We have seen a ton of appreciation here too. It kind of depends on the area a lot of times. For instance, like the west side of Buffalo has gone up tremendously. Some properties that you used to be able to buy for 50,000 like 5 years ago, you can now sell for 250,000 plus. So we do see a lot of appreciation here too. And then there's other areas that haven't seen as much, but there's basically not a place in the United States that hasn't seen at least some appreciation. Real estate has really gone up quite a bit. The cost of just building a house has gone up tremendously. Materials have gone up crazy amounts. I mean, just a couple of weeks ago, windows, the cost of a window went up $100. They used to be $250. Now they're not to install, and now we're basically paying $350 to put in a new window. So everything, especially lumber, has gone up a few $100% in the past couple of years too. So just to build a house, you can't build a house for the prices we're really selling them at. So these are older houses generally, but to rebuild a house like this is going to cost you over 300, easily over 300,000, not including the land. It's the typical spreadsheet that we send out. It kind of keeps track of all our properties, so we use it for our own purposes as well. And I highlighted just some ready ones. We recently just purchased this one on LaSalle. It's 380 LaSalle. It's in the university area. It's south campus of UB, which has about 30,000 students there. So you get a lot of student housing over there, and you can get a lot higher rents if you rent to students. This one is not rented to students. It's actually rented to mother in the lower, and in the upper, it's rented to her son. So those are the rent amounts. It's $700 and $650 sale price. And over here is roughly around like 9% return there, 8.89. But it's in good shape. Doesn't really need anything much. We do plan on doing some exterior work, but besides that, it's pretty much ready to go and available to purchase essentially. We also have like a 3-unit in Sloan on Mansion. That one is it's a pretty good area over there. The property we haven't. This one is the one we kind of just inherited all the tenants. They're all paying and pretty good right now. So it's not fresh rehab by any means, but you're getting a little bit higher return as well, at about 10.5% there. And then I highlighted this one. This one does not have a very good return on it, 7 Clark, Lancaster, but the area is super, super good. As you can see, 6.75%, which calculated return off of this with the taxes. And that's just the area is incredibly nice over there. The average house in Lancaster is about 250,000. So we're selling it for about half the average. And then here's why. This one is more it's a double. The rents are extremely low. It has a disabled person in the upper and his sister in the lower. So we don't really want to raise the rents too much. We did raise them. It was only $1,000 when we bought it. We raised them each like $50 just because it's still super low. Inside is not the greatest shape, and the floors are a little not completely level. But it is a really nice area there. And we just recently sided the entire exterior. There's no real basement there, and it's an older house, but it's more just a house that you're not going to find a cheap house like this in the Lancaster area, essentially. But you are, of course, due to the rents, not getting the stellar return. We got this one in Lockport, 27 Scoville. So this one we just rehabbed. It's a really nice property. As far as the condition goes, 900 in rent. There's the price, and then you're getting about 8.4% there. But it's a really nice property. The reason the rents are only 900 and normally rent more is just because it's a really small house. It's only a 2-bedroom, 900 square feet. But the area is pretty good, and the condition is excellent there. And then in Niagara Falls, we have just recently acquired this one in Michigan. It's a double. The tenants have been there a very long time. They're paying, they're happy. It's not a recent rehab, but the condition is good. So you're getting a pretty good return there too. And the area is pretty nice there as well. A very similar area to that is this one on the sale, 2467 sale. It's just a couple blocks down. This one is a single family home. Nice area. The return is going to be a lot less though, because it is a single family. You could probably sell that to a homeowner too, if the tenant were to ever move out and you want to just make it nicer, and then you could probably sell it for a lot more as well. But you would have to probably do a little bit more work to the property inside. But the tenant, also really good tenant there. Super nice, always pays, never had a problem basically there. Another property, here's one on 150 69th. I kind of just highlighted it. The return is not going to be very good here. Let's see. Yeah, it's 7.25% there.
Kayla, can you before you go over each property, can you say the item number on the left column so I can follow you? Item number, you know.
Yeah, so it's item number 65. So that's probably gonna depend, like, because we're constantly adding properties to this, so it's not really gonna.
Right. Okay.
Item number is not necessarily going to be the best indication of the property. I'll say the address is 150 69th Street, Niagara Falls. It's on this sheet. It's currently item 67. If you want to go by that, I mean 65. Sorry.
Okay. All right.
But 83.5 is the price. 800 rent. So that house, like the area is mostly like a homeowner area. You can see we have another property, a couple houses down on 227 69th that we're selling for 154, quite a bit more. The reason why this one is lower is because one, it's just it's basically completely outdated inside. It's got like wallpaper, paneling, older kitchen, everything's in nice condition as far as the condition goes. It's just crazy outdated, more or less. Very just more or less, yeah, just outdated. So that's why the price is there. So you're getting a lower return, but the neighborhood is really quite a bit more. As you can see, this other property on 69th that we plan to sell to a homeowner, we're going to be selling for in the 150s.
Wow.
And then I just highlighted a couple more here that are ready right now. Is 421 16th. This has a really nice tenant here. She's on Section 8. Rental assistance, always pays, been there forever. But because she's been there forever, we haven't really done a whole lot to the property. The area is okay there as well. The return there calculated here is 8.66% there. And then the last one I kind of just highlighted is 509 25th Street. That one's ready. You're getting a little bit higher return than that, but it's also not rehabs. This one is probably not in as nice as condition as this 16th one. The one on 421 16th, the tenant keeps super nice. It's like I've been in there a few times and it's always pretty much clean. And you're guaranteed basically, I think it's roughly half the rent Section 8 pays. It's a rental assistance corp. But those are the ones that I kind of just put ready. We're constantly getting more. We're buying roughly 15 properties a month still. But a lot of these too go to homeowners a lot of times when the returns are too low for investors. But it's basically that for how the sheet goes.
Yeah. Okay, let me ask you this. When an investor calculate the pro forma or the monthly cash flow, I want them to understand, do they calculate you have county tax, city tax, and school tax? You have to add all these three taxes for the cash flow analysis? Is that true?
Yeah, so basically everything on this sheet is already calculated. So this is just a basic Excel spreadsheet. And we do these like lookups for all the taxes. It's Excel formulas, but basically this calculation here, you could if you click on the individual cells, you could see how we get all these calculations,
right?
More or less. So we are taking into account basically everything that's up here. So we're taking into account the water that you pay, an estimation for the insurance, estimation for utilities, estimation for water, And then these are the actual taxes broken down by month. You do pay the taxes yearly, and they do come out at different times throughout the year. But we just take that yearly amount, divide it by 12, and you get the monthly amount.
So
And we just subtract it from the rent, and then you get your basically return here. So it's not your complete return, because we don't add in variable expenses such as any maintenance that you might have on the property. So you're going to have to subtract that out, because obviously that's just variable. We
yeah.
can't really know what's going to happen.
So Kayla, if I understand you correctly, so each investor, when they contemplating analyzing each property, they have to calculate, they have to add on all the 3 taxes, the county, the city, and the school tax, as part of the cash flow pro forma analysis. Am I correct?
Yeah, and we do that. We add in so this return here,
right?
This takes in to account the taxes, because that's a major factor, and it also takes into account an estimation for the insurance and estimation for any utilities that you pay.
Actually, Caleb, if an investor were to buy a single family home, they're not responsible for the water or the utility. But if an investor is going to buy a duplex or higher, if I understand you correctly, the owner, the investor, have to, on a duplex or higher, they have to pay the water only, but not the utility. Am I correct?
So this is, in general, yes, but it's not. That's not always. So in Buffalo, we just always pay the water. So even on single families, you're going to see an estimated amount here for the water. On singles in Niagara Falls, we have the tenants pay the water. But water is a kind of a different utility here. It's if it's not paid, it goes on your taxes. So you are responsible. If the tenant were to not pay the water, you are responsible for it, and that's kind of why we just pay the water, more or less.
Yeah,
the utilities.
Yeah.
So the utilities, like gas and electric, if the tenant doesn't pay, you are not responsible at all. So the utility company just has to try to collect that from the tenant. So that won't go on. So, but for doubles, we'll have the tenants pay their own gas and electric whenever we can. So if the gas and electric are separate, we're always making the tenant pay. But sometimes we have properties, I don't know that we have any right now, actually. Yeah, all those values are 0. But sometimes you will see a value in there if the utilities for gas and electric are not separate. Say there's just one hot water tank and one furnace on a property. Yeah.
So Caleb, now under type, I know it, but other investors that may not know, under the type category, I know SGL is single family home, and DBI is duplex, and triplex is clearly stated. So what's this acronym stands for those first timers?
Yeah. So this is just an abbreviation for single, and that's abbreviation for double, DBL.
Right. Gotcha.
So so I guess we couldn't have spelled it completely out, but yeah. That's, and then we just do the unit when it's
my next question is again, for any first-time investors, when they look at your spreadsheet, sometimes, especially for a newbie, they get overwhelmed. They don't know what to look for on your spreadsheet. So that's why you're here to clarify on this webinar. So now I understand the under status contract, that's fine. Somebody already under contract. You can, then you have reserved, somebody already reserved the property. And then you have future. So can you explain the category of a future property under status? What does it mean?
Yeah, so I'll just go over that. So basically, ready means it's ready. That is the finalized price and the rent amount. So if you said, hey, I want that property, I can send you a contract right now for that sale price and those rent amounts. That is correct. Now, if it says future, that means we are doing something to the property. It either we're rehabbing it or kicking out a tenant to rehab it, or something who's not paying or something. But we're basically doing something to the property, and therefore the sale price, it's estimated, and so is the rent amount is also going to be estimated, because if we're rehabbing a property, we don't know for sure that we're going to get this rent. It's normally pretty accurate, but the farther away we are from the property being completed, the more of an estimate it is. So if we're like 2 weeks away from completing the property and renting it out, it's normally a pretty good estimate. But if we're like 4 months away from being able to do the property, because some properties we're buying sight unseen from auctions, so we don't even know what it needs inside a lot of times. So it's really an estimate as
Yeah.
far as
So
yeah. So it depends.
Yeah, I got you. The future category, investors cannot reserve it. I mean, we can't do anything until the future category has been changed to ready. When it's ready, then we can bid on it. We can reserve it. We can buy it. Am I correct?
Yeah, you could buy it. So we don't even do bids. We just do first come first serve for the ready properties. So it's not like we're asked so it's not really a bid. We don't negotiate our prices at all. It's just that's the price. That's if you want it, let us know. We'll write up the contract, get it going. And yeah.
Yeah. So let me clarify this again. Under the future category, that is not available for sale. So investors cannot reserve it. They cannot buy it until the future is changed to a ready status. Am I right?
Yes. Yeah.
Now, some of the properties already is not annotated as reserved. That means that property was previously on a ready status and the buyer is under contract. Then you change the spreadsheet to show reserve until the property closes escrow, then they're done. Am I correct?
Not quite. So reserved, we use the reserve properties for cash buyers essentially. But we kind of stopped that. But some of these we've just had reserved for forever. Like for instance, even like this one on 24th, for instance, we've had this reserved for honestly almost a year now, because originally we couldn't even evict the tenants due to COVID. Now evictions are going through, so we had to evict a couple tenants there because we bought the property. One of the reasons why the guy was selling it to us was because he had problem tenants. So we evicted the tenants there. Now we're doing work on the property, but we had it reserved for a guy. He's actually one of your clients, Curtis, who we reserved it for. It's just been like that a long time. But basically reserved is not available. It's basically as good as under contract.
Right. So Caleb, so under a current future category, so the best a buyer can do, investor can do when they look at the future category is to wait until the future category becomes ready. So we have to investor could either consult with you pretty often to determine whether the future property gonna become ready. Is that the best way to? If somebody really like a future property as stated on a spreadsheet and they want it really bad, and they can't reserve it because it is under rehab, whatever. But as long as they kind of be persistent with you, Caleb, and then when the property is done with the rehab and you change from future to ready, so that investor, because that investor is so persistent, you will most likely, because you have a communication relationship with that investor, with the buyer, you most likely you're going to let the buyer prioritize and have a first chance to get this property because of the persistency. Am I correct on that?
Yeah. Well, so if someone expresses interest in a property, I make a note of it, and then so when it does change, it's ready, I could let the person know, hopefully right away. I mean, I do deal with a lot of people, so I don't like guarantee that I'm gonna. I hope that the investor kind of just looks out for it as well, especially because we do prefer cash offers over financing too. But we basically just do first comes first serve that way. But sometimes there's properties where there's multiple people, it's future, and then multiple people are saying, hey, when this becomes ready, I'm interested at least. Can you send me more information? So I'll make a note and send it out when that is the case. But we kind of do first. It's still first come first serve, more or less.
Yeah, so I hear you. I hear you. So, Caleb, so most of your buyers, from especially from overseas and Canada and Middle East, wherever, they usually buy with cash, obviously. So I have to assume that my investment group, and I really appreciate that, and you allow financing. So most of the time, you do not. People buy your off-market properties. Usually they pay all cash, except my buyers, which I prefer my buyers to get financing because my Wells Fargo loan agent, not Richard, someone else, as you know, Ian Dornfeld, he can do investment loans for any loan amount. So if you have a property listed for 50,000, my investors can finance that single family home or duplex for 50 or 60,000. And more often than not, your property, because you price it correctly, when the appraiser gets done, pretty much your property gets appraised pretty accurately, fairly accurately. Am I correct on my assumption?
Yeah, appraisers do pretty good job. Like we basically have, I've been doing this for 8 years. I've never had, for a single family, never had a problem ever. For a double, we've had a couple problems, or just because some areas we've had a double and then there's just not many comparables at all, because there'll just be like one random double
Right.
in a sea of single families, and they have to do like kind comparables and not off of cash flow. So we've had trouble, I think, two doubles like ever, more or less, and it wasn't that far off. But as far as the single families go, it literally never. And normally they're appraised much higher than what we're selling them for.
Caleb, you may or may not know that you've been that your market based on the price. I know the property is very old and 60, 80, 100 years old, but your rehab team have done a wonderful job rehabbing the property, make it turnkey. We get all that. So, not too many turnkey providers in the Midwest can have the great system that you guys have in place, right? Because you guys truly are the best turnkey provider in the Midwest. When I mean Midwest, Caleb, I mean, the Midwest, like Indiana, Michigan, Tennessee, or Illinois or Missouri, right? Those areas for many years have high cash flow, low price properties, and is a sort of a high cash flow play. And now we're getting, even in your area, we're getting appreciation, just like the rest of the country. So with my buyers, when they finance a 50, 60, or $70,000 single family home or duplex in your market and on your listings, I mean, the cap rate is like 7%. The cash on cash return is double digit, right? And the total return on investment, if you project 3 to 5% appreciation on your listings, we're talking like 20 to 30% total return on investment, and that's just the first year. So the number is really off the chart. So Caleb, I just want to share that with you. Over the years, our investors have achieved very high return on your high quality, low price, under the radar market. So I know you've been very modest, Caleb. So can you share, what I just said? I mean, you can pretty much validate what I just said is true.
Yeah, especially if you're leveraging, you can get a better return on the money you put down, cash and cash return for than what's on the sheet here. But then also what you said is like 3% appreciation. Like there's no place in Buffalo that's gotten that low of appreciation. Probably on average, basically for Buffalo, it's gone up like 10% a year lately. So if you bought a house from us like 3 years ago, your property is probably worth 30% more than what we sold it to you for. You could go ahead and just sell that property on the market right now for quite a bit more, in other words. And a lot of investors have who have purchased from us too. And I also just see now in the chat that Scott was wondering about the taxes. So I just want to go over the taxes really quickly to kind of answer that question. He was wondering if the estimated taxes are based on the new sale price or what you're paying now. So these are the prices that we're paying now, But in these areas, besides the city of Tonawanda, they don't reassess your property when it gets sold. Essentially, they do full reassessments of the whole of huge sections when they do it. And some areas have not been reassessed for an incredibly long time. Like in Niagara Falls, they haven't done a full reassessment in a very, very long time, in like a decade, pretty much. So your taxes are going to be pretty much are likely just going to be the same that they're showing on the sheet here too.